Boy, the whole student loan situation is a mess, isn't it, Joe?
You don't even want to get me started. The last 3 months, I mean, our phones, our calendars have been booked for 2 or 3 like weeks out at a time. I've had to open up different time slots. So yeah, it's been crazy. I mean, on that topic, we will start there. The whole save injunction, people going on to forbearance, being forced onto forbearance. Well, when you're on forbearance, obviously it affects qualifying for a home. And we've had a lot of people gearing up to buy a house like during the spring, and now they're all panicking because they're either on forbearance or they're on an income-based repayment plan and they can't recertify their income, which means they're going to get kicked off of it and put into forbearance. So I was like, let's ask the expert. What's going on with underwriting, with forbearance? What could people do? Is there anything they can do? So I was like, yeah, let me ask Josh, see what you got on that.
This reminds me of a Ronald Reagan quote, Joe. He said that I think he said the nine scariest words in the English language are, "I'm from the U.S. government and I'm here to help."
Yep, yep,
So, yeah, I
yep.
mean, there's a lot of unintended consequences in this stuff, and mortgages is one of those spillover places where there's a lot of unintended consequences. So, let's separate out the conventional mortgage world from the professional medical professional loan programs because there's a big difference.
Mhm.
So when you hear somebody talk about conventional loans, that's loans that are usually bought by Fannie Mae or Freddie Mac, which are these big government sponsored enterprises that buy up these huge pools of loans. And they have what's called conventional underwriting guidelines. And they're very cut and dry. There isn't a lot of gray area. Now, and then there's FHA loans and VA loans. Those are referred to as government loans, and they generally have fairly rigid underwriting guidelines as well. And then there's this other pool of loans, which are referred to as doctor mortgages, physician home loans, medical professional loans. And they are more unique and more pliable as it relates to the qualification of being able to be approved for those loans. So the point of me going back and explaining that is if you've been declined for an FHA loan or you've been declined for a conventional loan, that does not mean that you can't get approved with the same set of circumstances for a medical professional loan. So keep searching. So here's what the conventional loan guidelines say about student loan indebtedness and deferral payments. And FHA and VA generally follow suit. Medical professional loans have a whole different set of guidelines. They say that if you don't have a loan that's in active repayment, then you have to qualify based on a percentage of that outstanding loan amount. So if the outstanding loan amount is $100,000, conventional lending may say that you got to qualify at 2%. That means you got a $2,000 payment. Even if you're making a zero payment, the mortgage underwriter is going to plug in 2 grand for your student loan monthly payments, and that could put your debt to income ratio above the allowable thresholds, or it could push down the amount that you could qualify for. Conversely, when we separate out these medical professional loans, there's some alternative ways to document those things. First of all, if you can show that the loan's going to be deferred for more than 12 months, we don't have to count the payment at all. If you have any type of documentation from the servicer, what the future payment might be when you go into a future payment option, even if it's a income-based repayment or pay as you earn or any of those things. If you can get the servicer to produce a letter that says, here's what your payment would be if you enroll in that program, then we can use that payment. And if it's 187 bucks, it's 187 bucks, not 2,000. So every case is a little different depending on what the credit report shows. Because sometimes the credit report shows crazy stuff that's not even accurate, but it's better than the $2,000 and the person qualifies. We don't need any more documentation. Let's roll with it.